One of the big questions has been, we keep hearing about potential stress in the corporate debt market. Over the past 24 hours, we heard about Rite Aid filing for Chapter 11 bankruptcy. And the big question has been, who's next? Is this the first of many, many shoes to drop? Joining us is someone who is very much on the front lines of that, Steve. Thank you so much for being with us. I want to start there. You know, is Rite Aid sort of the beginning of this deluge of bankruptcies and defaults that a lot of people have been talking about?
Well, there's no doubt there's more distress in the market today than existed just 12 to 18 months ago. We're not involved in the Rite Aid situation, so I don't know much about the details, but I don't think Rite Aid has been in the conversation in distressed markets for a long time, fundamentally around the business model, the viability of the retail operations, and importantly, the opioid potential claims that might exist. I don't think anybody is surprised by Rite Aid filing, but I don't think it in and of itself portends a trend because now Rite Aid is just filed.
And some people would argue that for many years, people have been circling and hovering and expecting this company to go bankrupt. But there is a larger question, given how much interest rates, benchmark rates have gone up, the fact that you now have 30% of the high yield index paying more than 10% on their coupons, or the implication of that based on market pricing. How vulnerable to a rash and increase in defaults are some of the corporations that you're dealing with?
Well, those are exactly the fundamentals we look at. 10 years ago, rates were arbitrarily low for a long time. They've now crept up in a manner that people haven't seen for many. I mean, I've seen it in my prior cycles, but people haven't seen this for a long time. And when people look at leverage levels, what they fail to realize is that coverage levels are as important, what the operating cash flow is to debt service. And with rates up, variable rates resulting in increased interest costs to companies, and maturities now coming, those are the exact fundamentals we look to find out where the next round of distress might come from.
So where's it going to come from, and how much has your business increased in the past 6 months?
So what's great about our market is that there's like a perfect camera into the next 3 to 4 years. It's a very well-researched and covered industry. We see it kind of across the board, but in the near term, we're seeing it in retail, we're seeing it consumer, we're seeing it in tech, we're seeing it in media, we're seeing it in cable and satellite. Many capital-intensive industries with debt maturing in the next few years with significant need for new money. That's where we're seeing it. How busy have we been? It's been a good run for us, and that's in part due to the changing dynamic in the marketplace. Our business, which people may look at uniquely as a company's going bankrupt or advising company, that's not really what our business model is. The majority of our business focuses on companies that may have lost access to capital markets in the regular way markets. They're years away from needing capital, but there's actually another capital market that can be tapped, whether it's private credit, hedge fund capital, or frankly, the investors who are already in cap structures, and that's where we spend our time.